If you follow the financial news in Asia, you've probably heard a common narrative lately. Vietnam's currency, the dong, has finally stabilized. And if you just glance at the daily trading charts, it's easy to understand why people are saying that. The currency's not experiencing large daily swings from one morning to the next. Day to day, it looks calm. But the more interesting story begins in mid-2025. Since around August 2025, the dong has stayed relatively steady, although it's sitting at a weak level. The dong's not recovered strongly, but it also has not kept falling in the same sharp way as some other Asian currencies. This is what makes Vietnam interesting. The dong's weak, but compared with the Indonesian rupiah, the Indian rupee, and the Philippine peso, it's looked much more controlled in recent months. So this raises a question. Why has the dong stayed relatively steady while other regional currencies came under heavier pressure? The key is that stable does not always mean strong. A currency can move calmly every day, but still remain weak. There are two key concepts that you have to understand here. The first is daily stability. This means the currency doesn't jump up and down every day. The second concept is strength. This asks, has the currency actually regained the value it lost against the dollar? If we look at Vietnam through that lens, the answer becomes clear. Is the dong stable in terms of daily volatility? Yes, mostly. Vietnam avoided the sharper daily swings seen in some other Asian currencies. But is it strong? Has it recovered its overall value? No, not really. The dong is not rebounding. It's simply being held steady at a historically weak level. This is the key difference. A currency can stop moving wildly, but still remain weak. For businesses, that matters because they need predictability. A factory wants to know how much imported fuel, parts, and machinery will cost next month. A foreign investor wants to know that the exchange rate will not suddenly move against them. So when the dong moves slowly, it helps with planning. But because it's still weak, imported goods are still more expensive than before. So why did the dong settle into this weak but stable position? The turning point came in the middle of 2025. On July 3, 2025, around the time a major US-Vietnam trade deal was announced, the dong dropped to a record low of roughly 26,229 per US dollar. Just a few weeks later, on August 7, 2025, new US tariffs on Vietnamese goods officially took effect. The deal set a 20% US tariff on many Vietnamese goods, while goods treated as transshipped through Vietnam could face a 40% levy. For an export-dependent country, tariffs create immediate uncertainty. By September, Vietnam's prime minister was openly warning about rising exchange rate pressures and inflation, even as factories kept operating. Yet, this is where Vietnam's economy stayed strong. Even with the tariff shock, the country's third-quarter GDP in 2025 still grew by about 8.2%, and exports remained strong year over year. Vietnam's strong exports helped keep the economy growing, and that helped prevent the dong from falling much further. But later, by May 2026, Vietnam was facing new pressure. Inflation was rising, and the monthly trade deficit had widened sharply. That trade deficit is important in understanding the dong. Why? Because a trade deficit means Vietnam was buying more from the world than it was selling. Normally, that kind of pressure would weaken a currency. When a country imports goods, it often has to pay in foreign currencies, especially US dollars. So when Vietnam imports more fuel, machinery, electronics parts, and raw materials, demand for dollars rises. And when demand for dollars rises, the dong comes under pressure. So why did the dong stay relatively stable despite that pressure? The answer isn't exports alone. It's exports plus exchange rate management and investment inflows. Vietnam was still exporting a lot. In August 2025, exports were above $43 billion, and they were still growing year over year. That brought foreign currency into the country and helped reduce pressure on the dong. But exports didn't erase the pressure. Vietnam was also importing heavily, especially fuel, machinery, electronics parts, and raw materials. By May 2026, the monthly trade deficit had widened sharply. So this is the balance. Exports helped support the dong, while imports and the trade deficit kept pressure on it. That's why the dong stayed relatively stable, but still weak. Currencies aren't moved by trade alone. They're also affected by interest rates, investor confidence, and the strength of the US dollar, and central bank policy. And this is where Vietnam is different from some of its neighbors. Vietnam's exchange rate is more closely managed than a fully free-floating currency. So when pressure builds, the adjustment can happen more gradually instead of all at once. That becomes important when we compare Vietnam with its neighbors, because it's one of the main reasons the dong looked calmer than the rupiah, the rupee, and the peso. This brings us to a difficult balance for Vietnam. You have to understand that a weaker dong isn't always bad. A weaker dong can help exporters on the selling side because Vietnamese goods become cheaper for foreign buyers. But many Vietnamese exporters also import parts, fuel, and machinery, so the benefit's limited. A weak dong can support exports while still raising production costs. But this still leaves one question. If exports were strong, why didn't the dong recover? If we take a look at the data again on the dong USD, it's still trading near historical lows, around the 26,000 plus range per dollar. The reason's simple. Vietnam's strong exports were being offset by three outside pressures. First, lingering uncertainty around tariffs kept currency markets cautious. Second, the strong US dollar has put pressure on many developing country currencies. Third, and finally, there is heavy import pressure as fuel, raw materials, machinery, and electronics parts become more expensive while the monthly trade deficit widened. To run those large manufacturing zones, Vietnam has to import raw materials and fuel. When the global price of those commodities rises and your local currency's weak, you end up paying more just to keep running. By May of 2026, the pressure became clear in the data, with inflation climbing to 5.6%, alongside a record-widening trade deficit. That's why the dong looking stable in recent months can actually be misleading if we only look at daily movements. The economy remains resilient, but its money is still trading at historically weak levels. The difference becomes clearer when we compare Vietnam with its neighbors. Vietnam looks calmer because its currency moved slowly. Indonesia and India looked more stressed because their currencies moved more sharply. Let's start with Indonesia. In 2026, the Indonesian rupiah came under much heavier pressure. Bank Indonesia surprised markets by raising interest rates by 50 basis points to 5.25% to support the rupiah after it hit record lows. Even after that intervention, the rupiah was still trading near record low territory, close to 18,000 per dollar by early June. Then there's also the Indian rupee, which also came under pressure. The rupee recovered from a record low near 96.96 and trading around 95.7 to 95.8 in early June. Finally, the Philippine peso was also under pressure, especially because higher oil prices hurt oil-importing economies in Asia. Reports highlighted that the Philippine peso, right alongside the rupee and the rupiah, came under heavy pressure as the combination of higher global oil prices and a strong US dollar hit Asian currencies. When you're an economy that relies heavily on imported fuel, a strong dollar affects you twice, once at the oil terminal and again at the currency exchange desk. When you place Vietnam's chart next to those sharper daily swings of its peers, the dong looks much calmer. So, has the dong stabilized? It depends on what we mean by stable. Has it stabilized in daily movement? Yes. But has it recovered its strength? No.